Are you looking for a way to generate passive income without making your life more complicated? In this video, I'll show you the top 5 dividend-paying ETFs that reward you with monthly payouts, even while you sleep. These ETFs are ideal for investors who want consistent income, long-term potential, and less daily effort. And here's the best part. You don't need to be a financial expert or spend your days glued to the markets. Just make smart, intentional investments and let time and dividends do the work for you. Whether your goal is to supplement your income, build wealth over time, or eventually live off your investments, these ETFs can help you create a reliable cash flow every single month. Stay until the end, because ETF number 1 is often overlooked, but it has a powerful dividend history and could completely shift the way you think about income investing. Let's dive in. Before we jump into the list, let's make sure we're on the same page. What is an ETF? ETF stands for Exchange Traded Fund. It's essentially a basket of assets, like stocks, bonds, or real estate, that you can buy and sell on the stock market, just like a regular stock. But instead of buying just one company, you're investing in many at once, giving you instant diversification and reducing your risk. Now, some ETFs are designed to pay dividends. That's a portion of the company's profits shared with shareholders. Most dividend-paying ETFs pay quarterly, but some go a step further and pay you every month. That means a predictable stream of income every 30 days. This is ideal for retirees, people building passive income, or anyone who wants cash flow they can plan around. Plus, monthly dividend ETFs are often less volatile than individual stocks, and some even come with tax advantages, depending on your country. These ETFs are an excellent way to let your money work for you, with very little effort once you've invested. At number 5 on our list is JEPI, or the JP Morgan Equity Premium Income ETF. This fund is managed by JP Morgan, one of the largest and most respected banks in the world. What makes JEPI unique is its dual strategy. First, it invests in high-quality, low-volatility U.S. companies, the kind of companies that generate steady earnings and have strong fundamentals. Think of brands like PepsiCo, Microsoft, and Procter & Gamble. Second, it uses a strategy called covered calls. This means the fund earns extra income by selling options on the stocks it owns, essentially renting out the stocks for a premium. That extra income goes directly to investors like you. This combination allows JEPI to pay a monthly dividend that often ranges between 7% and 9% annually, which is significantly higher than most stock funds. It's important to know that JEPI is not built for massive growth. Its goal is income and capital preservation. So while it may not double your money overnight, it's great for stable, consistent returns. If you're someone who wants to reduce volatility and earn regular monthly income, JEPI is a solid choice. Next on our list is SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. This fund focuses on 2 things: high dividends, low volatility. SPHD selects the 50 companies from the S&P 500 index that not only pay the highest dividends, but also have the least price fluctuations. This makes it ideal for investors who want steady income without wild swings in value. What kind of companies are in SPHD? Think of utility providers, consumer staples, and big-name dividend stocks that don't tend to crash during market turbulence. Historically, SPHD has delivered a 4% to 5% annual yield, paid monthly. That means you'll receive 12 payments a year, which you can use or reinvest. One of the reasons SPHD is popular is because of its balance. It doesn't chase the highest yields, which can often be riskier. Instead, it aims for sustainable income with relatively stable performance. If you're building a long-term passive income portfolio, SPHD deserves serious consideration. Coming in at number 3 is DIV, the Global X Super Dividend US ETF. Now, this one is a bit different. It focuses on small and mid-cap companies with very high dividend yields. That means it can be more volatile than others on this list, but also has the potential for higher returns. DIV's strategy is simple. Target companies with above-average dividends. Rebalance regularly to maintain yield. Pay investors every single month. Yields for DIV often range between 6% and 8% annually, depending on market conditions. Sometimes even more. Because it invests in smaller, less-known companies, the fund can experience more ups and downs in its share price. But for investors who are okay with some extra risk, DIV offers strong cash flow potential. It's ideal for those who want aggressive income and are comfortable with short-term price fluctuations. At number 2 is QYLD, the Global X NASDAQ 100 Covered Call ETF. This ETF is very popular among income investors for one reason. It pays some of the highest monthly dividends you'll find in the ETF world. QYLD invests in the NASDAQ 100, home to tech giants like Apple, Amazon, and Google. But instead of just holding the stocks, QYLD uses a covered call strategy to generate income from the volatility of the tech sector. This income is then passed on to you, the investor, in the form of monthly dividends. The yield? Sometimes 10% or even more annually. Sounds too good to be true? Here's the trade-off. QYLD's focus is pure income, so it tends to sacrifice capital appreciation. In other words, don't expect your share price to grow significantly over time. But if your goal is cash flow rather than growth, QYLD delivers exactly that. It's a favorite among early retirees, people building passive income portfolios, and those who want regular payouts from a familiar sector. And at number 1, we have Realty Income, ticker symbol O. Now, technically this isn't an ETF, it's a REIT, or Real Estate Investment Trust. But we had to include it because it's known as the Monthly Dividend Company. Realty Income owns thousands of commercial properties, including pharmacies, convenience stores, and supermarkets. Tenants include well-known brands like Walgreens, 7-Eleven, and FedEx. Here's what makes it stand out. It pays monthly dividends like clockwork. It has done so for over 600 consecutive months. And it has a track record of increasing those dividends year after year. Realty Income gives you exposure to real estate without having to buy or manage properties. And you still benefit from rental income, collected and distributed to shareholders. For income-focused investors, O is often considered one of the most reliable sources of monthly dividends on the market. Now, the big question you might be asking is, how do I actually start investing in these ETFs? To begin, you'll need an account with a brokerage platform that gives you access to the US stock market. If you're based in the United States, some of the most trusted brokers are Fidelity, Charles Schwab, Vanguard, TD Ameritrade, and Robinhood. They allow you to invest in these ETFs with zero commission and offer tools for both beginners and experienced investors. If you're in the United Kingdom, platforms like Trading 212, Freetrade, or Interactive Brokers UK are solid options. They offer access to US ETFs, often with no trading fees. For viewers in Canada, great choices include Questrade, Wealth Simple Trade, and Interactive Brokers Canada. Just keep in mind that US dividends are usually subject to a 15% withholding tax. And if you're watching from Australia, check out Stake, Self Wealth, or ComSec. Stake, in particular, allows Australians to invest directly in US ETFs. And if you prefer a global solution, Interactive Brokers is available in over 150 countries, offering low fees and access to thousands of international assets. I'll leave the links to some of these platforms in the description below, so you can start with whichever fits your country best. Start with small amounts, stay consistent, and you'll build your passive income stream month by month. You don't need thousands of dollars to begin. You can start small, even with $50 or $100, and make regular monthly contributions. As you build your ETF portfolio, you'll begin to see how powerful compound income can be over time. And if you want to analyze charts or backtest strategies, I recommend using TradingView as a professional-grade platform that's perfect for beginners and advanced investors alike. Check the description of this video for all the links you need to get started. Before we wrap up, here are a few final tips. Diversify. Don't put all your money into a single ETF. Spread it out to reduce risk. Reinvest your dividends. If you don't need the income right away, reinvesting can dramatically increase your future wealth through compound growth. Watch the expense ratio. This is the annual fee charged by the ETF. The lower, the better. Understand what you're buying. Never invest blindly. Research each fund, read its fact sheet, and know its risks and rewards. Stay consistent. The real power of these ETFs comes from long-term investing, not quick gains. Now tell me, which of these ETFs do you find most interesting? Are you already investing in any of them? Let me know in the comments below. And if you found this video helpful, make sure to like, subscribe, and click the bell icon so you don't miss the next videos where I'll continue showing you smart ways to make your money work for you. Thanks for watching, and I'll see you in the next video.